Welcome back. In this lesson, we're diving into what makes insurance contracts unique. These features set insurance apart from other types of contracts and are essential for your understanding as you prepare for the insurance pre-license exam. Let's start by introducing some key terms you'll encounter in this section: aleatory, unilateral, conditional, personal contracts, and valued via indemnity contracts. Don't worry, we'll break each of these down with examples. First, insurance contracts are aleatory. This means the exchange of value between the parties is unequal and depends on a future uncertain event. For example, a homeowner might pay small annual premiums for years without ever filing a claim, but if their house is damaged in a fire, the insurer could pay a much larger amount than the premiums collected. The performance of the contract is contingent on a specific event, like an accident, loss, or death. Next, insurance contracts are unilateral. This means only the insurer makes a legally enforceable promise. The insured is not legally obligated to continue paying premiums, but risks losing coverage if they stop. In other words, the insurer must fulfill its promise to pay benefits if a covered loss occurs, but the insured's role is more flexible. Insurance contracts are also conditional. This means certain conditions must be met for the insurer's promise to be fulfilled. For example, if the insured fails to pay premiums or doesn't provide proof of loss, the insurer is not obligated to pay the claim. Remember that the insurer's obligations are contingent on the insured's compliance with the terms of the policy. Insurance is often considered a personal contract. This means the agreement is between the insurer and the individual, not the insured's property or assets. For example, auto insurance doesn't transfer to a new owner if the car is sold. However, there's an exception for life insurance where policies can be transferred to another person through an assignment process. Finally, let's discuss valued and indemnity contracts. A valued contract pays a predetermined amount, like the death benefit in life insurance. An indemnity contract reimburses for actual losses, like medical bills or property damage. These distinctions are crucial for understanding how claims are processed. Let's recap the unique features of insurance contracts: aleatory, unequal exchanges based on future events; unilateral, only the insurer makes an enforceable promise; conditional, the insurer's obligations depend on the insured meeting certain conditions; personal, agreements are tied to the individual, not the property; valued, and indemnity contracts. Different methods of calculating payout. These unique features make insurance contracts different from other agreements. Understanding them will give you a strong foundation for your exam and your career in insurance. Thanks for watching. I'll see you in the next video.